Increasingly, there are investors who want to align their investments with their values, beliefs, or ethical ideologies. As they say, good ethics is good business. And there is a merit to that argument. There is a lot of overlap between various beliefs, values, or ideologies. Most ethical frameworks would not include or approve investments which includes businesses like alcohol, gambling, tobacco, etc. If you see it closely, many such businesses run risk of government policy, regulations, or changing consumer preferences. So avoiding such businesses makes sense and therefore the first set of exclusions. There are well established principles of various ethical ideologies that help us define sectors or businesses to avoid. This helps us create a well defined list of exclusions and help investors to align their investments with their values, beliefs, or ethical conduct. Portfolio construction is a four pronged approach that includes liquidity, ethical exclusions, integrity screening, and financial screening. Liquidity, our criteria is to invest in stocks that trade at least $1 million a day on an average over the last 12 months. 1 million will translate to roughly 8 to 8.5 crores of trading value on over last 12 months on an average basis. What it helps us, it helps to deliver a transactable NAV to investors and to help scale the fund without compromising any portfolio characteristics of the fund. Second is ethical exclusions to avoid companies that do not meet the defined ethical criteria. Third is integrity screening, companies with great governance, credible board, able management, relative lower external risk, and treats minority shareholders at par. So this is a definition of a well-governed companies that have delivered well over the long run in terms of quality of the company that they stand for. Fourth is the financial screening. Companies that have made good capital allocation decisions, navigated business cycle well, have strong balance sheets, are profitable, and generating free cash flows for investors. While aligning investments with ethical conduct and high integrity businesses, we also want it to be good investments for investors. Financial screening helps us avoid bad businesses from an investment standpoint and hence generate returns for investors over the long run. We believe that the above combination of factors result in a resilient portfolio that would deliver results for investors over the long run. Probably, one would say that while having an ethical exclusion, you tend to avoid certain companies which may do well. However, at the same time, there is also risk in those companies from a government policy or regulation or changing consumer preferences. So it works both ways. It may or may not immediately deliver over the short run, as these trends tend to take time to showcase potential from a risk reduction or return enhancements perspective. So one needs to have a long-term view while investing in an ethical fund. Markets have seen some correction recently, which has made valuations a little better as compared to the expensive valuations prevailing then. So a good time to start investing in markets again. All those investors who are not investing earlier from the lack of alternatives to invest in the equity markets in an ethical manner, here's an avenue for them to invest in equities that also align well with their values, beliefs, or ethical ideologies. So hopefully you would start investing into equity markets to have an ethical approach to investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.